In this session, we will be starting off with our first unit. The first unit is Introduction to Accounting and Accounting System. In this unit, we will be getting a theoretical understanding about on the subject of accounting. So with that note, let us start. Before we get on to understand the basics of accounting, let's try and define what is a business transaction. If you look at any business scenario, if you look at any business, how any business would operate, it would all be based on transaction. Any business works on the rational, works on the fundamentals, works on the basic concept of a business transaction. If you think of shopping something through Amazon, basically it is a transaction that you're carrying out. If you decide to order some food on Zomato or Swiggy, basically it is a business transaction that you're carrying out. Or if you decide to order some groceries from home from Big Basket, it is a business transaction that you're carrying out. So basically, what is a business transaction? A business transaction is an activity, it is an economic activity which involves the exchange of goods or services in exchange of money or money's worth. So, for example, on Amazon right now, we have the great Indian shopping festival which is going on. You decide to buy a brand new phone. So, what is happening over there? You want a phone, that is the good that you want, and then when you decide to buy that on Amazon, you have to pay the money for it. Or you decide to enjoy a good lunch by ordering some biryani. You picked up Swiggy or you picked up Zomato, you found out your favorite restaurant and you placed in that order. What are you carrying out? You're carrying out a business transaction. So you are availing a good in return for a payment of money. So the entity, the institution, the organization which carries out transaction is called as a business. So what is basically a business carrying out? The business is facilitating the interaction between a seller and a buyer. Who is a seller? Someone who has a good or a service. Who is a buyer? Someone who wants the good, someone who wants the service. In return, they are willing or they are ready to make the payment. That is a buyer. So interaction between these two categories of people is what we will call as a business transaction. So in a business transaction, one important aspect that we have to remember is there is a seller on one side who has some good, who has some service. There is a buyer on the other side who wants the good, who wants the service. In return, they are ready to make the payment. So the interaction between these two categories of people is essentially what we will call as a business transaction. Moving on, we will talk about some important terminologies that we will be discussing in accounts. Who is a proprietor? A proprietor is a person who starts a business. Now, it is just not that a proprietor is willing to start a business. You also have to remember there is a lot of risk which is associated with a business. So, probably your business may not pick up as the way you wanted it to. It may run into a lot of losses. It may run into a lot of problems. It may not yield the result you desired it to. So there is a lot of risk which is associated with it, with running a business. But the proprietor is the person who's willing to start that business and he's willing to take up all that responsibility on his shoulder. So that person is referred to as a proprietor. Then you have capital. What is meant by capital? Capital refers to the initial money which is contributed by the owner or proprietor to start a business. So for you to start a business, there is some amount of money that you have to bring in. That money is referred to as capital. Now, one important aspect you have to remember over here is for that money to be called as capital, proprietor has to bring in that money. Apart from proprietor, if anyone else brings in money, you cannot call that as capital. Okay? So for capital to be referred to as capital, the proprietor has to bring in money. When the proprietor brings in money, that is referred to as capital. The third important terminology that I want to discuss with you is the concept of drawings. What is drawings? So drawings refers to the money which is taken by the proprietor for his personal use. So let's say the owner realized that he's got some importance, he's got some need, and he wants to use the money. So for using money, then the money that he will be taking out from his own business, that is referred to as drawings. Now, for you to call drawings as drawings, you have to remember the money has to be taken out by the proprietor or the owner. Apart from the owner, apart from the proprietor, if anyone else takes out money, you cannot call that as drawings. Okay, you cannot call that as drawings. If anyone apart from the owner takes the money, and just in case if that is without your permission, then that is stealing. Okay, you cannot call that as drawings. So the condition is proprietor has to take the money for his personal use. That is when drawings would become drawings. The next important terminology that we would be learning is the concept of asset. What are assets? Assets are basically resources. If they are, there are resources that would be taken by the business, and these resources are needed so that a business can function effectively. A business can function efficiently. Okay? So assets are basically resources which are needed by a business to function properly. So what are the possible items that you can call as assets? Asset can be land, asset can be furniture, asset can be machinery. All these are referred to as assets. So assets are resources which are needed by a business so that a business can function effectively. Then the next terminology that we will be talking is obligations. What are obligations? What are liabilities? Liabilities are obligations. Obligation is a commitment that you have to fulfill. So, for example, you decide to go out somewhere, but unfortunately, you forgot to take your wallet. So, you decide to borrow money from your best friend. Now, that's an obligation. Why? Because you must pay that money back. The money has to be given back. That is called as a obligation. So the obligations of a business is referred to as liabilities. What is sales? Sales refers to exchange of a product or a service. Okay, so when you carry out sale, the seller is giving out his product, he's giving out his service. In return, he's collecting money. That is referred to as sales. Then there is something which is called as purchase. What is purchase? Purchase refers to acquisition. You are acquiring, you're getting some asset, you're getting some products from somewhere. That is referred to as a purchase. So these are some important terminologies. I'll run you through the terminologies once again. Proprietor, owner of the business; capital, money brought in by the proprietor; drawings, money taken by the proprietor for his personal use; assets, resources needed by a business; liabilities, obligations of a business; sales, exchange of products or services for money; purchase, acquisition of product or a service for money. So these are some important terminologies that we have learned. Now we will be talking about maybe 4 more terminologies, and those are revenues, expenses, profit, and losses. What is a revenue? Revenue refers to income which is received by a firm as a result of its activities. So you may be selling some goods, you may be selling some services. So in return, you would be making a collection from your customer. This money is referred to as revenue. Then you have expenses. What are expenses? Expenses refers to cost which is incurred. Okay, cost which is incurred by the firm. Okay, cost which is incurred by the firm, that is referred to as expenses. So for you, maybe you may be needing raw material, you may be needing labor, you may be needing some technology, you may be needing electricity. So all these are referred to as expenses. Then what is referred to as profit? Profit is a condition when the revenue is more than the firm's expenses. Okay, you say your business is profitable. When you say your business is profitable, you would say your business is profitable when your firm's expenses are more than the firm's firm's income is more than the firm's expenses. That's when you say a company is profitable. Then when you say a company is running on loss, you say a company is running on loss when the expenses are more than the income. Okay, when the expenses are more than the income, you say that the firm is running on losses. Okay, so these were some more important terminologies that we had discussed. Okay, these are some more important terminologies that we had discussed.